Indexed universal life, is it good or is it bad? If you go on TikTok and Instagram, you're gonna find thousands of people trying to tell you that indexed universal life is the solution to all your problems. Just get all your money out of your 401ks, IRAs, put them into an IUL, and you will be good to go. You can get more income in retirement. You can have upside potential, downside protection. All of your financial problems will be solved. That's what they say. Is that the truth? Well, in this video, we're gonna talk about Index Universal Life, the different options that come in Index Universal Life. I want you to understand how they actually work, not just how they're being sold to you. And then at the end of the day, you can make your decision on what you believe is best for you. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Well, let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and in this video, we are talking about Index Universal Life, one of my favorite conversations in the world. I just got back from a World Financial Group meeting. It was a conference. There were like 700 people there. It was one of the biggest teams in the World Financial Group organization. I got an invite there. I actually did a live while I was there. I watched Doug Andrews speak. It was a very challenging time for me, but I'll put the link if you want to watch the live response that I had while I was there. You could check that out. But in this video, what I want to do is go through, it was inspired, I should say, by that event. And I want to go through how Index Universal Life actually works. Because if we go back in history with Index Universal Life, it was created in 1997 by Transamerica. It didn't become popularized. It didn't gain market traction until about 2009. So that's a 12-year window when it existed, but it wasn't super popular. 2009, it became popular because of the story of upside potential and downside protection, meaning you have a cap and then you have a floor. You could earn up to the cap, but at least you couldn't lose money. So coming out of the year that we had in 2007 and 8, where people just got, wiped out, the conversation and that story of that, okay, you give up some of your upside potential, right? But you're capped, you could still take advantage. And back then the caps were 15, 16%. Now they're 10% in most situations, 13, I guess, in some of the companies, but 10% in most legitimate companies. Would you give up anything above that to make sure that you can never lose money? And then they sell the story about, hey, you can never lose money, downside protection, you have this floor, zero is your hero, and there's all these conversations that go on around it. That story led to the popularity, and now IUL is becoming the most popular and most sold cash value life insurance product in the business. And I think that is led by all these IMOs that are literally hundreds of thousands of agents that are selling this. And what I got this weekend was there's hundreds of thousands of agents across the country that are being taught how to sell this improperly. And unfortunately, we need to get people's education up. Out of the few conversations I was able to have with people, what I realized was when people actually learn the truth, they want to do the right thing. And so they realize, like, oh my gosh, there's a threat of discontent now. They're uncertain about how to do this. And so I make these videos to be able to give you the information. A, if you're a client, if you're somebody who's looking at doing it, you can make a more educated decision for yourself. And B, if you are an agent, I think you need to understand this stuff because nobody in your organization is going to teach you this. And so let's get into it. I'm going to share my screen, and there's some things that I want to talk about. Now, the main focus on this video is this idea of no capped IULs versus capped IULs. Now, the reason I want to bring this up and the reason this is so important, I think, to talk about is because of the fact that when we look at the history of IUL, we have capped IULs. The IULs, I should say, always had a cap rate associated with it. So you would look at the IUL, there'd be a cap rate, there'd be a participation rate, and that was that. Over the years, cap rates came down. So when I say over the years, I mean from, let's say, 2009 to 2020, 2017 to 2020 is when no capped indexes started becoming more popularized. But as cap rates came down, the story was not as attractive of upside potential and downside protection. So what did they do? They came out with all these uncapped indexes, and they came out with proprietary indexes which were effectively uncapped. That's the reason they came out with the proprietary indexes. And so what that did is it created this perception that you had all this crazy, amazing growth inside of this IUL from a long-term perspective, and you still gathered the 0% floor. So that seemed like an amazing win-win for everybody involved. And so my question is, well, how's that even possible? If it were that great, all the smart money in the world would be flowing into it, and that's not the case at all. So what we're gonna do now is we're gonna get into this. And I wanna say this, is that when we look at this, whether it's a cap rate, which I think is important, right? Like I said, we had either cap rates, participation rates. And now, even if you don't have a cap rate and they do an uncap, when we do no cap on the IUL, they either have a participation rate, they have a spread charge, or they have a no risk rate. And sometimes they have multiple things all to take into consideration in one. And so when we look at these three things, these are moving levers that can impact your performance in the IUL. I know they're sold as conservative, but I know the illustrations are positioned as being very conservative, but that isn't necessarily the case. I'm gonna try to keep this video really quickly because I wanna make it so more people get this. Now, what happens is we need to look at this. We have to understand the flow of money, okay? And this is really important to understand. So what I'm gonna do here is we have to look at this and we have to think about, all right, if you don't understand options, you should never buy an IUL. That's the first principle to understand. The second one to understand is you need to understand the flow of money. You gotta understand the flow of money inside of your IUL contract. So basically what happens is you pay your premium, right? Pay your premium, and a portion of that premium goes to the cost of insurance and charges. That's part of it, and then part of it goes and it goes to cash value. That cash value goes and it gets a return and creates an options budget. And that options budget goes and buys call options. Now here's the deal. What we need to understand is this option budget is going to be dictated by the performance of the general fund when we look at this, right? So when we look at this options budget, this could be anywhere from 4 to 5 or 4 to 5% right now. And it could go up, but this options budget can go up or down, okay? That's important to understand. Now, the call options, we have to also think about options costs come into play. So what we have to look at is the options cost. And what we have to think about is as the market is more volatile, these options costs can go up or down as well. And so these are things that come into play. Now, when we add these two things together, these two things combined set the performance of an IUL, okay? And so it is so important to understand that all of the moving parts, the things that we just talked about, these can all be changed. I mean, you can't change the fact that it's a no cap, but the fact that if the participation rate, the spread charges, and the no risk rates can all be changed based on this environment, right? And so if we look at this, the participation rate can be upped or lowered. The spread charge can be increased or decreased, and you have to look at on the illustrations, you have to look at what are those ranges and are you comfortable with the potential of the company moving them. Now, I will say that the company is not gonna just move them to sabotage you because the company doesn't keep that extra money. The company is simply dealing with a budget based on the cash value and the rate of return that they're getting to create an options budget, and then they're buy and call options. So the amount of call options is going to be determined by your budget and how much they cost. And then those things will determine, and this is why I say you need to understand options, because those two things together are going to determine the price of the cap rate or the no cap rate or the performance or the participation rate, spread charges, or no risk rate. Now the no risk rate is typically tied to the 10-year treasury, right? And so when we look at that, the 10-year treasury rate typically follows along with your options budget, and so when we look at the fact that goes in there, that's going to be an extra drag and a fee, and That basically is there on these no cap rates to protect the insurance company, and it's basically the cost of money. It comes into play, and you have to think about that. Now, when we look at this is the part that I think we need to understand. When you understand these two variables, and we understand, all right, this is how it goes. Money flows in, it comes into your cash value. It's going to create an options budget. We'll see what that options budget is. We know then we need to go buy call options. We'll have to figure out and determine the call options, and that will set the actual performance levers that the insurance company is allowed to move around. Okay, now we have the facts about how the money flows into the IUL. Now here's what I'm going to use the S&P 500 as the example for this, because what we need to understand is, at the end of the day, the S&P 500 is going to perform how it performs. So what will happen is you can go into an index and they're going to say, all right, you could have a cap rate, and I'm just going to do this of, let's say, 12%, right? That could be an option, or you can have an uncapped rate. And this is what people do. It's mind-blowing, and you got to realize how illustrations work. The uncapped rates, they're going to show you like little 1 year and 2 year periods of history, and they're going to talk to you about how well they did, in 2020 when the market was going crazy and recovering from the COVID crash and all these different things. But the bottom line is, using these two examples, what's going to happen is you're going to see that there's the uncapped rate is unlimited upside, right? You participate fully in the market and it still gives you a 0% floor. But what happens is, on the illustration, as far as the conservative illustrated rates, they're going to show you, and it might be like 7%, let's 6 to 7%. And they'll be relatively close for each of those. So if you're looking at those things and all things being equal, you're like, well, why would I? And you got to read the illustration for this. This is why I'm saying you got to read every page, every line of your illustration before you sign on the dotted line. And if you haven't done that as an agent, well, shame on you to understand what you're selling. But if you look at these two things, well, how could an unlimited cap with a 0% floor, only illustrate the same as a 12% cap with a 0% floor? Why would that be the case? Well, it's because these actually don't really matter, because when we go back to here and we understand the money, and the fact is that we got cash value going in, we're going to create the options budget. Okay, that's the same on everything. Now we got to figure out the call options. Well, guess what? In this instance, if we're buying call options on the S&P 500, well, those options costs are going to be the same no matter what, because it's the same index, right? So it doesn't matter which strategy we had. If we're dealing with the same options budget and the same options cost from a long-term perspective, you can't draw blood from a rock, you're going to get, relatively speaking, the same long-term performance. At the end of the day, the company baked into the policy has these three areas, basically, that they're going to be able to control the moving parts. And when you break it down, yes, an uncapped rate can have a big year, but make no mistake about it, there are going to be hang-ups on that strategy that will make it so the other capped rate will perform better, because uncapped rates either have, typically par rates, they have spread charges, I'll call it spreads, or they have the no risk rate. And sometimes they have two out of those three that go into the play, that go into the, into the calculation, the formula of how these things are created. And so ultimately, at the end of the day, that's why these things don't perform as sold. They're sold as a great concept, but they're wildly complicated. And I got news for you. If it actually worked the way that they sold it, then I would certainly be doing it. I used to sell IUL. I would have never gotten rid of my IULs if it worked the way that they sell it, but it just doesn't work that way. So what was the solution here? IUL companies came up with this thing called proprietary indexes, or engineered indexes, and they went out and they created uncapped. This is where uncapped indexes became really popular. The reason they created these uncapped indexes is because if you understand, once again, anything about options, well, then you understand the options costs go up. Options for the S&P 500 are a supply and demand product, right? And so what happens is options in volatile markets get really expensive. But on top of that, as IUL has become more popular, it's created their own problem over the past decade because we have more dollars chasing the same amount of options, right, of the S&P 500. So we got to think about that. And in volatile markets, those options costs get more expensive and that makes it hard. So what did? They created these uncapped indexes that were proprietary, that were hypothetical lookbacks and like Zebra Edge, the Mosaic 2, there's a lot of indexes like this, but they create these uncapped indexes. And the problem is that these come with fees. There's a lot of fees that are added into this, and there's a lot of smoke and mirrors that go into these indexes. And at the end of the day, you need to be very, very, very cautious. I would never, ever put money into an uncapped index because on top of all the other things I said above with these no risk rates, charges, fees, these additional fees and costs on the back end become a huge drag on the performance of the policy because this is on top of everything else. There are no free lunches in this world. The reason they created these proprietary indexes is because they were only for the underlying IUL and annuity for that specific company. So it's a proprietary, meaning if Transamerica wanted a proprietary index, if Nationwide, if Symetra, if Allianz, they all want their own proprietary indexes, they're only being used for these products, right? So when we look at that, the fact that this is what's going on, the crazy part to me is that people look at this and they go, all right, well, it looks good on paper, but they don't look at the fees and they don't realize that the reason this was created in the first place and the only reason is to lower options cost. Because remember, options are a supply-demand issue. And so what they do is they have this here and they put it here and they're able to buy options on this proprietary engineered index and they're basically making bets on how it goes. There's going to be a cost that goes along with that and they're able to just kind of play the game with the big banks and the big, where all the money is, and they're basically making bets. So your question is like, what do you think is good for you? The problem is, when you bake this all out, and I'll say this is like they go through and they try to say, all right, you're 30 years old, and you need to save 10,000 per year. And, by the time you're 60, you put 30 years into it. And so you've put 300,000 of premium in, that should lead to a cash value of, let's just say you've done that. Let's say 1.2 million. So the idea would be like, all right, at 1.2 million, you can, and let's say you had a $500,000 death benefit or something like that. You got $1.7 million of death benefit, and as you're going through this is the idea that, and I watched Doug Andrew talk about this the other day. He's like, all right, you can get 8% for income. The problem is, as we get older, the cost of insurance is going up, and now we have loan costs that go on this. The idea on an illustration of what makes it work on paper and what makes it look so sexy on paper is that you always have this 0.5% of positive spread. So meaning you're going to pay to borrow that 8%. So of income. So let's just call it 100K of income. So the idea and what makes it look really good on paper is that you're going to have $100,000 of income. You're going to have to pay a 5% loan rate. That 5% loan is going to cost you $5,000, right? But on the other side, you're never taking that money out. So that $100,000 is going to be earning 5.5%, which is $5,500. So the idea here is that because you're going to reduce this, you're going to change this $500,000 of extra death benefit. You're going to change this to option A, which is a level death benefit. And the idea is this extra $500 every year of credit more than the cost is going to eat, it's going to keep increasing your cash value. And so the next year you'd have $499,500 of death benefit, reducing your net amount at risk, which hypothetically and theoretically would reduce your insurance costs. That's what they tell you. What they don't tell you is that on years where the market does less than 5%, anytime the market does less than 5%, you have extra costs, extra charges, extra fees. And when you've done 5, 6, 7, 8, 9, 10 years of these loans compound against you. And I've shown on other videos, and I'm not gonna go into great detail here, but I've shown that when you do this, literally a 0% market year can equal a negative 20% performance, or a loss of 20% of the net cash value in the policy. And when that happens when you're in your 70s, late 60s, early 70s, it only takes 2 or 3 years like that in a 5-year period to completely decimate your policy. And when you do that, if that happens to you and you're not 75 and you don't have the overloan protection rider in place, which you don't have, the overloan protection rider only works once you hit 75 years old, you don't just lose your income and lose the policy or have to come out of pocket to keep the policy in force. You're gonna get hit with a tax bill, not just for the income that you took and spent, but for all the accumulated loan value, because you're responsible for all of that. And so it's really important to understand, this is when people ask me, why do you not like IUL? It's because of these reasons, or a failing financial experiment. The reality is, when we look at the fact that they were created in 1997, but nobody's really started selling them on mass scale until 2009. But even if we go back to 1997, we're talking not even 20, it's just about 26 years ago, right? So what I tell people is, like, there's not a person alive, not one. It's not mathematically possible. Everybody sells this like it's fact, and they run these models and illustration models like it's going to be amazing. I got news for you. There's more class action lawsuits and lawsuits settled and sealed in arbitration with insurance companies with this product than any other insurance product in history. Why is that the case? It's because of the fact that these policies don't perform, and regulators know it. And they know it because in 2015, they created Regulation AG 49, which reduced the ability for the insurance companies to be able to illustrate at high rates and high assumptions. Because let's face it, these insurance agents are just selling based on the illustrated performance and making you believe that insurance companies would never put something that's not, predictable or honest, as if these insurance companies have some level of morality attached to them. They wouldn't put anything that would be deceptive on an illustration. Okay, fair. I think a lot of companies are good, but if you look at the history of how insurance companies treated universal life policyholders in the 90s and 2000s, when universal life failed after its boom in the 80s, I think you'll see where things are going to potentially go here. And what I look at in this is that there's not a person alive has been able to fund an IUL for a 20-year period, or let's call it a 15-year period, and has had 10 years of successful withdrawals or loans utilizing it for tax-free income in retirement, because the policies haven't even been around long enough to do that, but people are selling them like they are. And when we go back to regulation, well, when they created Regulation AG 49 in 2015, okay, it was supposed to solve the problem, but insurance companies just created workarounds to make it so their illustrations would still perform really well. Well, then in 2020, they created Regulation AG 49A, which then was supposed to reduce the performance. Well, guess what? Insurance companies just created a workaround and made their performance still look really good so they could keep selling them. In May of this year, 2023, they created Regulation AG 49B, which once again was supposed to reduce the performance, and once again, IUL companies created workarounds in the formulas to be able to make them perform even higher. So I'm expecting massive regulation overhaul on how illustrations are allowed to be done. I'm concerned that it's going to overflow into other areas of the business, which I think would be tragic. But if these things performed the way that they're illustrated, then regulators wouldn't be doing what they're doing in chasing down and trying to hammer down the illustration tactics that are happening by the insurance companies. Now, that's not the insurance agent's fault. They're just doing what they're trained to do. That's it. A lot of these companies are the problem. It's not the insurance agents, it's the companies that are doing this to get the sales forces and the training out there on the potential of these things. But I got news for you. If you believe an IUL illustration is going to perform the way that it's sold to you, I have a unicorn I can sell you, right? Like that's the way that this really works out. And so I think this is stuff that you really need to understand if you're going to be looking at selling it or buying it. And after going to this World Financial Group convention and seeing how it was taught to people and seeing kind of how listening and overhearing conversations and hearing what people were saying about how they worked, sitting in rooms and hotel rooms at the conference center, having conversations with agents about what they're taught, what their uplines are teaching, looking at the fact that, you know, their compensation model is totally in opposition to like how they're telling people to structure these things. They say, hey, you got to, as long as you properly design an IUL, you're going to be good. Well, I got news for you. A properly designed IUL, meaning an overfunded IUL, a max funded IUL, the only way that that will work is for death benefit only. That's it. If you get an IUL and you max fund it and you want to keep it for a legacy play and that's your plan, okay, cool. You can have liquidity of some of that money, which is a benefit. So if you want to borrow against it and leverage it and use it and then pay that money back, that's okay as long as you pay the money back. But the problem is if you do an IUL, even a max funded IUL, as soon as you start utilizing it for retirement income, that's when the wheels come off. And my big issue is that most people are not going to realize this until it's far too late, and they're going to be screwed. And I think that there's going to be a big unwinding of this entire industry, and I'm just worried about all the people that are going to get caught up in the crosshairs. So anyway, that is it. Hopefully you found value in this video. If you did, please like it, share it, get it out there to people, share it with the agents. Like this is the information that is so basic but so important. If you do not understand options, do not buy this product. Okay, like that really it's what it comes down to. So yeah, and I think when you do understand options, you're going to look at this and be like, holy crap, like that is the last thing I want to do. You're taking the power of the skill of what the life insurance company does really well, and you're letting them gamble with it is really what you're doing when you put your money in an IUL. It just makes no sense. And you become a profit center for a company instead of a partner with a company like you would be with a whole life policy. So that's it. So anyway, if you have any questions, reach out. Down in the comment section below, I engage with every single comment. Feel free. There's also, if you're an agent and you want to learn how to do this, there's a link down below. You can go learn how to have an interview with one of my coaches, and they can kind of bring you through a process and teach you some stuff and show you what you can do with your business and do a lot of stuff there. And if you are somebody who has a policy and is interested in having an evaluation of that policy, go to rescuemyiul.com and we will give you a free evaluation of what your options are from here moving forward. So that is it for now. Have a blessed, inspirational day. We'll talk soon. See ya.